Hello, everybody. Thank you for joining us for today's webinar. We have the Economic Mid-Year Recap of 2021 with Mark Schug. My name is Rob Lipson. I'm the VP of Business Development and Sales here at Lightspeed. We're happy to present various topics of education, whether it's regarding the economy or our software or trading services, support on our technology, and other aspects of the trading industry. And certainly the economy plays into that a very big part. We've had Mark do many presentations with us previously, so we're very happy to have him. We will get started shortly. I'm just going to do our quick disclosure here, and then we can get started. This presentation is for informational purposes only. Nothing presented today should be construed as investment advice or recommendation to buy, sell, or hold any security or contract. Since we don't know everyone's investment objectives or risk tolerance, we're not endorsing any specific trading strategies. Security derivative futures trading involves a substantial risk of loss that's not suitable for all investors. Each investor must consider whether this is a suitable investment, since you may lose all or more than your initial investment. Past performance is not indicative of future results. Lightspeed Financial Services Group, LLC, is not affiliated with these third-party market commentator educators or service providers. Data, information, material, this content are provided for informational and educational purposes only. This content neither is nor should be construed as any offer, solicitation, or recommendation to buy or sell any securities or contracts. Any investment decisions made by the users through the use of such content is solely based on the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Lion Brokerage LLC does not endorse, offer, nor recommend any of the services or commentary provided by any of the market commentators, educators, or service providers. Any information used to execute any trading strategies is solely based on independent analysis of the user. Thank you. For more information on a demo or opening an account with Lightspeed, please feel free to contact me. Once again, my name is Rob Lipson. It's rlipson@lightspeed.com. It's RLIBSON. Feel free to request a demo from our website and let us know if you have any questions. We're happy to help. As for our presentation today, we have the economic recap for the mid-year 2021. Dr. Mark Schug is a professor emeritus at the University of Wisconsin-Milwaukee, directed the Center of Economic Education, taught for 36 years at the middle school, high school, university levels. Widely recognized scholar, has written and edited more than 230 articles, books, and national curriculum materials. Received national awards for leadership and research in economic education, Council Economic Education, Association of Private Enterprise Education. He's been a guest editor. He's done many presentations for us in the past. We're happy to have him. So he definitely knows the economy and knows what is occurring and maybe what's going to be happening, and keep an eye out on the future. So we're going to turn the presentation over to Dr. Schug and have him share the highlights of the past mid-year. So we're just going to change our presentation here quickly and have Mark take it away. Thank you, Mark, for joining us.
Okay, well, thank you, Rob, for the introduction. It's good to be back with everybody at Lightspeed, and let's get right to it here. Just in case, if you want to get in touch with me, it's markschug.com. That's my website, and you're certainly free to go there. I'll show you my email before we're done. Usually a couple folks do ask for the slides, and I'm very happy to share them. So if you see something that you'd like to look at a little more carefully, don't be shy and just let me know. This is a small enough set of slides that I can actually just send them to you as an attachment. So I don't have really real extensive graphics, so that keeps it a little bit light. Okay, so this is the first time we've done a mid-year recap. And it's certainly going to be, there are some different things going on in the economy than when we did the one in December. That's quite obvious. So we'll be seeing some new things going on. So how have we done so far? And so we're going to talk about some big economic numbers here, like GDP and things. And what forces are pointing to strong growth in the second half of 2021? What forces are pointing to slower growth in 2021? And how, nobody knows how the markets are going to perform in the second half, but I'll show you a few projections that people are making, and you can judge for yourself. So how has the economy done? Well, we've had this whipsaw, right? where in the second quarter in 2020, we got just destroyed. And then as the economy started to reopen, we saw this massive return. You see that this is the percentage change from the preceding quarter. So that that graph second to the end there, that bar second from the end here, that's like a 35 or 36% jump in GDP. So that's, you're still seeing the change from the pandemic. And then that number continues to grow. I'll show you the actual percent, the actual gain here in just a minute. So just to remind everyone, GDP is a big economic statistic. It's collected that there are like hundreds of economists that work on this at the Bureau of Economic Analysis. You can always go to the BEA to check the latest announcements that they have, the latest press releases they have. So it's consumption, it's investment, it's government spending, and it's net export. So consumption, that's the big deal with consumers. So we're going to have a big story here about consumer spending. That's about 70% of GDP. So everybody always looks at consumption spending. Investment spending is a little tricky. That's not investment the way you normally think of it. You guys are all investors, but investment spending in GDP actually means business spending. And we tend to look at that as being important for investors because that's telling you where businesses are sort of going forward. If they're doing a lot of spending, like building up inventories or building new plants and acquiring new software and hiring people, well, that's an indication that they think things are going to be revved up into the future. Government spending is exactly that. It's state, local government spending, national, state, and local spending, and then net exports. So we count stuff that we export. The United States is still a huge exporter, but we have to back out stuff that's not made in our country. Yeah, so imports have to be backed out in order to understand. See, GDP is a measure of our production, our total production. And so exports are made in the country, imports are not, so we have to back out imports. So you see in 2019, it was a almost $21.5 trillion economy. A trillion, remember, is 1,000 billion. So this is huge number. But you see in 2020, due to the pandemic, then the serious recession we had, we lost ground. And now we're well into 2021. And as you can see from this graph, where you see the little arrow there, that's showing the continued increase in GDP. What you're seeing there is where the arrow is an annual rate of 6.4% in the first quarter of 2021. That's pretty remarkable growth. That's a very positive number. Typically GDP is 2 or 3%. To see 6.4 is really important because that means the economy is really going. It's largely driven by the reopening of the economy. But of course, you know that in this particular environment, the government had a lot going on as well. And so in the first quarter, these, the government assistance, the payments that went out to households and to businesses, so that had a direct economic impact. Payments went out, expanded unemployment benefits, and payroll protection. Many businesses, many even nonprofits got loans in terms of to help them get through their payroll period. And of course, those loans were then forgiven. You remember the Coronavirus Response and Relief Supplemental Appropriations Act, the American Rescue Plan, and then the Coronavirus Response and Relief Supplemental Appropriations. We'll look at these a little bit more because it's relevant a little later in the presentation too. But we know the government spent an awful lot of money trying to help the economy not go, completely into the tank. But the main increase in real GDP is being driven by personal consumption. So that's that C in gross domestic product. But we're also seeing a nice increase in business spending. That's the I in GDP. And so business spending and businesses are building up inventory. So that's all very positive so far in 2021. And we also saw increases in durable goods like cars and trucks. So that again, in bad economic times, so if consumers feel you're walking up to a recession, they generally stop or decrease their purchases of durable goods like cars. Like instead of purchasing a new car, they go out and repair the existing car. Right now, you know, if you've heard anything about what's going on with cars and trucks, you know, the cars and trucks are just flying off the dealership floors. So what suggests strong economic growth in the second half? So we just looked back to the first half. So now what are you thinking? Well, this is, you know, there are a lot of economic forecasts out there. So I'm going to show you 2 or 3 of them. And then we'll take a look at housing and manufacturing, which continues to be strong, and interest rates continue to be low. So there's a lot of story in here that we'll follow. But I wanted to, you know, the last couple times we've done this, I feel I am not telling you the fullest picture here. Forecasting is not economists' real strong suit, right? It's often our forecasts have to change. I'm going to show you some very respected forecasts, but still, there are so many things that drive the economy that it's very hard to get this in sort of a simple model that it just be like things related to climate change too. It's very, very hard. The climate's very complicated and the economy is very complicated, and it's very hard to know totally in advance what's really going on. And if you remember the housing market collapse in 2007, almost nobody, this was a real black eye for economists because, boy, they did not, very few. There were some warnings in the Wall Street Journal editorial page, but almost nobody saw that coming. So you want to take these forecasts with a grain of salt. We sometimes wonder about confirmation bias. They all seem to be pointing in the same direction, and I couldn't find anybody that wasn't pretty upbeat. And then the Fed has been changing its predictions as things change. So the Fed makes adjustments too, and their predictions are not always spot on. But this is what we've got. Now, this is a very respected survey of forecasters that's done by the Federal Reserve Bank of Philadelphia. And they're predicting 7.9% growth this quarter. That'll be up 2.9 from their previous predictions. So over the next 3 quarters, the panelists in this survey also see a strong rebound in output growth, then a stronger rebound than they saw previously. So that looks pretty good. Here's their graph. So I'm showing you that with the arrow, this 7% that they're kind of hovering around. But look at the red beneath it. That was their previous to look at blue now. That's their current. So they're seeing a pretty strong, you know, so they're thinking 7% growth, almost 8% growth. So that's pretty confident. So I went over to Wells Fargo to see what they're doing. Kind of the same story. They're coming in around 7%, and that would mark the second fastest year for growth since 1955. The full-time growth in 1984 was 7.2. So this is sort of historically high, but coming out of the pandemic, which was a historic disaster, it's still, you know, it should be expected. They're also pointing out that it's increasingly evident that the fastest pace of expansion in decades comes with growing pains. So, you know, we've seen all these supply chain issues. We'll talk a little bit about them when we talk about inflation in a minute. So we'll hit on that later, but we're all keenly aware of how difficult it is to buy a new car. There's, you know, in the housing industry, there's been a lot of issues and so forth. So here's their prediction. So that little red arrow is showing what, so the little blue ones are showing real GDP in 2020, and you can see a strong prediction at 7% from Wells Fargo, where that red arrow hits the red column on the second from the right, and then it would decline a little below 6% shortly after that, in the quarter after that. So still pretty significant growth. And then we'll take a look at the Federal Reserve Bank of Atlanta. They run something called GDPNow, and this is an estimate of GDP based on data collected in the current quarter. So if you want to check these out, it's real easy. Just Google GDPNow, and you can turn this up. And so this changes periodically. So this is from June 15th. and the next update is going to be June 24th, which is tomorrow. And so let's see, in the second quarter of 2021, they're saying growth is 10.1% on June 16. So they're predicting 10.1. That's down from 10. They're saying 10.3. That's down from 10.1 that they said on June 15th. But still, I mean, that's just monster high growth. So the folks at the Atlanta Fed are pretty upbeat. And here you can see, or the arrow is there. That's getting into their 10% range that they're looking at there. So that tends to be a pretty optimistic number coming from the Atlanta Fed. If we check out the housing market, of course, it took a big hit during the pandemic, and it has rebounded amazingly. Homes are viewed as more important today. People are snapping up homes left and right. Many of them are looking for more space. Many people are moving to areas, say, outside of New York, especially the Midtown and the real heart of the city, moving to places like New Jersey, but also moving to places like Florida and elsewhere in seeking larger homes. And interest rates, due to the Federal Reserve monetary policy, continues to be low. So here's the this is the housing market index from the National Association of Home Builders. And you can see that it's remaining pretty steady in terms of new homes being built. And there was an article in the Wall Street Journal this morning that showed existing home prices are at an all-time high. That's $350,000. In Palm Beach County here where I am, the median price of a home is $400,000. But anyway, this $350,000 number from the Wall Street Journal, this is their front page story this morning, is 25% up over last year. So, boy, the housing market is hot. Sales, as this sort of suggests, sales themselves aren't are at a very high level, but are a little slower, and that's largely because homes aren't staying on the market very long, and so that we really have kind of a shortage of homes on the market in terms of existing homes. So it's still the picture in housing is pretty upbeat. And here's our friends at the Institute for Supply Management, and this is their most recent report. They're saying they're looking at manufacturing still being very positive. You see it's at 61.2%, down slightly, but anything over 50% is regarded as positive, and this is pretty substantially above 50%. And this, if you dig a little deeper here, and you see their projection is the economy growing faster over the next 12 months. So the overall economy growing faster and the manufacturing sector growing faster. So generally upbeat in terms of manufacturing. And then I like to look at one other one, and this is this economic uncertainty index. And this has declined considerably. This is kind of an interesting index. What these people have put together, this is a group of economists that have got a model that traces the largest newspapers in the country. And they look at the articles to see about reports about uncertainty, about taxes being increased and that sort of thing. And what they see is, now look at that, that's really a nice change from the last time we looked at this. That's a big drop down. You're almost down to normal levels. That 100 level is about normal. And so you see the big spike we had during the pandemic. And so that, if there's a lot of economic uncertainty, businesses, that's a caution to businesses. Businesses want to wait until the dust settles to see what's going on. You don't want to risk your capital when you don't know how things are going to turn out. So right now, it appears that people think it's safe to come back in the water in terms of being a business. So what about problems? What are forces that might be pointing out to slower growth? Well, here we go, brand new stuff. Now, we went from a trickle of an occasional article you'd see in the newspaper or in the financial news about inflation. Well, now we see it all the time. And the measure for inflation, the primary, there are a few different measures, but the primary one that economists point to is the Consumer Price Index. So let's just actually kind of read this. The Consumer Price Index, or the CPI, is a measure of average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. So the key word here, and I should have probably italicized it, is average. So we're looking at average prices across the economy. So you go to the grocery store and the price of lettuce goes up, and you say, "Oh, we have inflation." Technically speaking, we don't have inflation. If you don't want the lettuce, go buy some cabbage or something. You could easily substitute something for lettuce. And so prices go up and down all the time according to supply and demand, what's happening in the markets. In the stock markets, prices go up and down all the time. It's all driven by supply and demand. But when we see sustained inflation, like an average change in prices, that's what gets people worried. So the classic definition of inflation is too much money chasing too few goods. I'll elaborate on that in a second. So here's the Consumer Price Index. It's compiled by the Bureau of Labor Statistics. The CPI reports a price index of a market basket of 300 items. And this is what the market basket looks like. So that big blue spot in the middle, well, that's housing, that's 41%. So the average family in the United States, they project, is putting about 41% of their spending is going into housing. And after that, it's going into transportation and it's going into food. So getting around, food, shelter are the big things in the market basket. Now this varies, right? If you were a college student, this might not quite fit. I'm kind of a retired dude here, so I don't pay that much for housing. I pay some, but I don't have a home mortgage or anything. And so, this is really trying to see the average consumer, and you can imagine the issues because this stuff changes over time, right? So the economists that run this have to make changes in their market basket over time. But anyway, this just gives you an idea of what they're actually measuring. Okay, so let's apply this a little bit. So here's Milton Friedman. Milton Friedman is a Nobel Prize winning economist who passed away in 2006. He's extremely well known. You've probably heard of him. He was regarded as the dominant economist regarding monetary policy for decades. He kind of wrote the book in terms of monetary policy for the Federal Reserve. That's a whole other story, but one for another time. But he says very famously, and I really want you to listen to this. This is a bold statement. Inflation is always and everywhere a monetary phenomenon. All right, so inflation is being driven by the amount of money being poured into the economy. And the money that we're really talking about can come from consumer spending, it can come from government spending, like Congress, and it can come from the Federal Reserve. So let's just read that again. Inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. So just to paraphrase that a little bit, the amount of money coming into the economy is outpacing output. Output is GDP. That's when you get sustained average increases in prices. So the price of lumber is up, it's starting to come down. Right, that's probably just a difficulty with supply chain issues. It has to do with some other issues too that we'll touch on in a second here. But right, so if it's just an adjustment in supply and demand, that's sort of one thing. But if the quantity of money that's being pumped into the economy from these various sources is larger than GDP, that's when you get inflation. All right, and the consumer price index increased 5% in May. That's following several other increases, and you can see my graph here that's showing, this is annually working out to be 9 to 10%. That's a little scary. That's a pretty big hop in inflation. So the recovery that we're getting in jobs and some in wages and from the relief payments handed out by the government is, being gobbled up by inflation, if it's sustained. And that's the big question. We'll get to that in just a second. So where's this inflation coming from? Well, if it's a monetary phenomenon, let's look at fiscal policy. So Congress has passed about $6 trillion in response to the pandemic. That's 25% of GDP. Remember, we saw GDP was around 21, 22 trillion. Well, when you put in 6 trillion, that's a really big proportion of GDP. 2.2 trillion came from the CARES Act, another 500 billion from the Payroll Protection Program. There's something called the Consolidated Appropriations Bill. That was nearly 1 trillion. And then the more recently passed American Rescue Plan was another almost $2 trillion. So that works out to about 6 trillion. So that's a big chunk of money being poured in. Now you hear we're going to kind of channel Milton Friedman. Now, Milton Friedman was known as a real free market oriented guy. Larry Summers is not. Larry Summers is more of a Keynesian, and he was an advisor to Presidents Obama and Clinton. And this is what he says. So Larry Summers, former Treasury Secretary, warned that federal spending may create at least 3 times the size of the output shortfall. So he's just saying the same thing again, right? That it looks like federal spending is outpacing GDP recovery, and that's Summers is the guy on the far left here. So you see President Obama and at that time Vice President Biden. So the guy on the left there with the kind of crabby look on his face, that's Larry Summers. Okay. So, and then the Fed has got its foot on the gas pedal. So the Fed controls some key elements in terms of interest rates. It controls something called the federal funds rate. It also controls money supply in the way it pays interest to the accounts that banks hold with the Fed. So if you're a saver and you have a savings account, okay, so you have a savings account at Wells Fargo, fine, and you may draw off that account once in a while. Well, banks have their savings accounts kept at the Fed, and the Fed pays a little bit of interest. And so the Fed can influence rates by moving the interest rate up or down on the accounts held by the banks that are held at the Fed. So the Fed is keeping interest rates low, and it is also simultaneously buying $120 billion worth of bonds. And those bonds, 80 billion are in treasuries. So when Goldman Sachs and other big institutions buy federal securities, in auction, this is, the Fed is Treasury is auctioning off treasuries to cover the debt, to cover the deficit. So the Fed goes into the secondary market and buys 80 billion a month in treasuries, and then it goes to banks and buys another 40 billion. What it's trying to do here, I don't want to dwell on this for too long, but the 80 billion in treasuries, the whole idea is then a Goldman Sachs and these other big institutions get 80 billion a month, and then the idea is that they're going to loan that money out in the economy. And the same with the 40 billion in mortgage-backed securities. So that's coming largely from banks and other financial institutions. So the idea is that money will also be loaned out. So, and then I'm showing you in the graph, the Fed balance sheet. So when the Fed buys these things, they buy treasuries and they buy mortgage-backed securities, you see how they're on their balance sheet, this is how that's how they do their bookkeeping. So it's almost $7 trillion they've got, and you look at the rapid increase since the pandemic. So this is the Fed with its, it really has its foot on the gas here. There's no doubt about it. I'm trying to move my slide. Why is my slide moving? There we go. Okay. And consumers are flush with cash. So another source of spending in the economy are consumers, as we saw with the gross domestic product numbers. And what I'm showing here, and businesses are spending too, is the graph is showing the personal savings rate. And, it's been up and down, but it's still at a historically, when you look at where it is right now, it's over 15%. That's at a historically high level. So we're thinking that people have taken some of the checks that they've received and not spent it. And if they drop their savings rates back to their more normal levels, a lot of that money is coming into the economy. So, and then one other factor, while we're talking about classical people in economics, well, there's a guy named Adam Smith who is regarded as the founder of economics. He wrote a famous book called Wealth of Nations in 1776, and he's well known for his endorsement of low tariffs and largely free trade. Well, this is also an issue. The Trump administration implemented tariffs, as you remember, on lumber, on steel, on semiconductors. And the idea was to protect American companies from foreign competition. Got it. But there's no doubt that tariffs are just another form of tax. So one of the issues with lumber issues is the tax we have on lumber coming from Canada. So this also, another reason economists generally favor low tariffs or even no tariffs is because it's a tax and it raises prices. It raises domestic prices by boxing out international competition. So economists regard generally international trade, and I know we've got issues with China, of course, as being a good thing for consumers because it helps keeps prices low and it helps make businesses competitive. Well, so I'm waiting for the Biden administration to maybe give some thought to backing off of some of these tariffs. That would certainly help with the inflation side of the story. So the big question for investors, is this just a short-term spike that we're seeing in prices? And we're overreacting. We shouldn't, and the Fed certainly thinks, and I was checking around, I saw many mainstream economists at banks and other financial institutions pretty much agreeing with the Fed. There's some little disagreement. Wells Fargo forecasters are saying that the transition might be a little longer than the Fed thinks, that we're going to see this jump in inflation. It's going to take a little longer for the supply chains to get straightened out and that sort of thing. Or not. Is this a pattern where we're going back to double-digit inflation, and having lived through the 70s and 80s and having tried to sell a house in 1978, I can tell you 20% interest rates were no fun. And so if inflation continues, the Fed will need to raise interest rates, and it's going to need to taper off its bond purchases. And on Friday, they announced that they might be raising rates as soon as late 2022. And of course, you saw the markets, I think the Dow was down 500 points on Friday. So generally, the mere mention of raising rates spooks the stock markets as it did on that day. So that's really the big worry here is this a transitory thing? And Jay Powell, the president of the Federal Reserve Board, was just saying that again yesterday in congressional testimony, that they see it as transitory. And they're saying, well, we've got the tools if we need to do it. Now, if high inflation is prolonged, investors typically seek shelter. And one kind of security is called a Treasury Inflation Protected Security, or a TIPS. And so some investors seek shelter in there because that's a security that's automatically adjusted for inflation. And then there are the old hedges that you normally hear about, like gold and other commodities, when there's a big fear of inflation. So that's the big news story. And then, of course, there is something in terms of the national debt. The debt is at a level that is higher than World War II. And we are basically in peacetime. So this big push of spending, you can see that projected spending there is that little yellow piece. And this is from the Brookings Institution, but it's based on Congressional Budget Office data. I got the graph from Brookings, but CBO is the source. You can see that this is dangerously high. So what's dangerous about having a lot of debt? Well, one of the things is that interest payments go so high. So my little arrow here is pointing to interest payments as part of the federal deficit. That's what gets scary, is that soon interest on the debt starts to push out other forms of spending from the federal government. So we depend on the federal government to make payments in terms of Social Security and Medicare. We also depend on the federal government to do things in education and infrastructure. We're hearing a lot about running the court system, of course, military defense. But the mandatory spending is so large that it crowds out the non-mandatory spending. And part of non-mandatory spending is interest payments. So as we issue these bonds to cover the deficits, eventually the bonds have to be paid back. So when people say, well, we're pushing this debt on our grandchildren and we're putting a burden on them, that's what they mean. We're not paying for it right now. This is going to be paid for down the road. And this is right from the Congressional Budget Office. You can get this data in about 5 seconds. The CBO is actually kind of pessimistic about the level of debt that we have. So I'm not going to dwell on that, but that would be a story for another day if you wanted to talk sometime about the issues related to the national debt with these very high deficits. Of course, deficits are the shortfalls, the current shortfalls in spending, that we're spending more than we're taking in terms of tax revenues. But then those shortfalls or deficits all get rolled into the national debt, and eventually those bonds become due and the interest has to be paid on those bonds, or we default. And not wanting to take lessons from Argentina and Venezuela, the Americans are certainly going to pay our debt. So that's a big issue out there. So how might the markets perform in the second half of 2021? Well, and Rob, you're going to let me know if we have any questions out there. I don't know if any have come in, but let me just wrap this up and then we'll see if, and we don't have that big a group, so we can take some time for questions if you like. So where are the markets headed? Well, nobody knows. So that's the fast, honest answer is the markets are a little hard to predict, but let's just take a look at what people are saying. The Wall Street analysts, again, this is not people at their best. It's hard to predict where markets are going and then to figure out what sectors. But it's true that most Wall Street analysts are optimistic about stocks. These folks what they're looking at is what we just looked at. They're looking at the GDP growth. They're looking at consumer spending and the anticipated period for low interest rates. They are also much more optimistic as people have gotten vaccinated and the pandemic issues have eased. But also, we're not fully back. We were just at a lovely place called Colonial Williamsburg, and with our daughters and our grandkids. And it was mostly open, but it wasn't completely open. And several of the various taverns and things were still not open. And a lot of the fast food places are still not totally open for dining, although they seem to be opening quickly now. And so what this is to say is that many of these analysts think the economy still has a little room to run. All right, so we still will be seeing more opening. We also had a very good corporate earnings period in the first quarter, and so those were better than expected. And where you see some of these shortages going on, that may actually spur some investment in places like energy. And so looking at some of the other ones, RBC Capital Markets slightly upgraded its stock outlook for the S&P 500, citing the stronger outlook for corporate profits this year. Deutsche Bank predicts a more upside for equities also, and that's due to the rebound from the pandemic. This is kind of verbatim right off of their report. Goldman Sachs also raised their S&P 500 earnings outlook due to higher corporate earnings and the rebound from the pandemic. I see after pandemic should have a period. Sorry about that. And this is what the markets look like today. So the S&P is really quite smart. I think I'm not sure if it set a record today. I didn't check, but it certainly is very high. And I think it set a record within the last 2 or 3 days. And the Dow is just down a little bit, but you see in the more recent period there, you see we took a little bit of hit there on Friday, but it's back. It's coming back. So generally, these two indexes look pretty good. So what sectors? Well, again, what are these analysts saying? Well, the analysts are saying manufacturing, and we're seeing, and cars and trucks look like a hot area. Energy, there's all the talk about alternative energy sources and solar and whatnot, and that solar might turn out to be a good pick. But a lot of people have been saying oil for quite a long time, and you've seen oil prices, gas prices at the pump have been going up. If we start seeing the shale producers coming back, There are some issues regarding that in terms of the current administration not permitting federal permits for drilling on federal land, although that's snarled up in court. There's been a lawsuit on that. Steel, upbeat again, because many of the things being involved in manufacturing have steel. And of course, the big return in terms of cruising. So the cruise companies are coming back, airlines, hotels, things related to the travel industry. Last year, stock pickers flooded into tech stocks, largely because of the pandemic. But now I think we're seeing some breakout on that people are more fine-tuning their thoughts regarding and being a little more selective and going for some of the smaller tech companies, not always just headed for Amazon and Google and Facebook and Netflix and that sort of thing. So once over lightly, well, in the record book, it's clear at this point that the economy has performed pretty well so far in 2021. Economic forecasters are predicting that the economy will continue to grow in the second half of the year. Housing and manufacturing look strong. The policy uncertainty index is declining smartly, so that's good news. The biggest, the big elephant in the room is inflation, which might cause the Fed to raise interest rates and taper bond purchases sooner rather than later. But we're still probably off into 22, maybe late in 2022 before they'll move. But again, if inflation really continues at this very high rate, if the CPI continues around 5%, it makes me wonder that they might have to change course. And as we said, they have a couple of different tools. One is how they try to influence the federal funds rate, and the other is how they pay interest on the deposits that banks have with the Federal Reserve. So they have those tools available. Investors appear to be upbeat for 2021. Manufacturing, energy, steel, and travel all look pretty good. So that's my story. And if you want to email me directly, it's mschug@uwm.edu. That's University of Wisconsin-Milwaukee. Or if you can remember how to spell my name, even if you don't get it right, I think it'll come up in your browser, www.markschug.com. This presentation isn't on there, but you get my email from there, and you can find my phone number. So I'm not like hiding. So if you want to talk to me or drop me an email, that'd be just great. I'd look forward to hearing from you. So we have a little time. Rob, are you seeing any questions at all? And I may click on questions here to see if I see anything. Is this what could make the market tumble? I think what would really make the market tumble is a change in Federal Reserve policy. That's the big player. We look to the Fed as the institution to manage inflation. They have two things they're supposed to do. They're supposed to maintain employment. This is what's called the dual mandate. They are to maintain employment, and they are to control prices. That is, try to keep prices stable. If you take, this will be a quick defense of the Fed in its current policies. If we really look not just at the last couple of quarters, but if we look at the quarters during the pandemic, we see inflation wasn't moving very much at all. And so if you really look at over, say, 6 quarters, inflation doesn't look quite as scary as it does in the last 2 quarters. So that I think is the big thing. I kind of wonder a little bit, see, are we looking at a housing bubble? See, the Fed, by keeping interest rates so low, the big beneficiary here is manufacturing in the car industry and in the housing industry. People go out and get loans at relatively good rates. So, yeah, those would be my worries, that maybe we have a bubble in housing. If we have a bubble in housing, that really affects a lot of people, and then we'd see consumer spending go down. And when housing goes south, when housing begins to decline, if that would happen, that affects so many industries. There are so many things that go into housing. just think about how many different sectors are involved in producing things for a new house. So, but I think my primary worry would in fact be inflation and Federal Reserve policy. Have we got any other questions? That was from Sean, I think. I'm trying to see if are you seeing any more questions, Rob? Okay, I'm not hearing from Rob. All right, anybody else have any questions? Okay, oh wait, here's chat. Let me see. Okay, I'm not seeing any more questions except the one from Sean. So I'm getting ready to wrap up. Rob, you want to come in? Okay, I'm not hearing anything from Rob. Rob? All right, folks. Well, I see people are starting to drop off. That's just fine. Don't be shy about getting in touch if you'd like to, if you've got some questions about the slides, and tell your friends they can go to YouTube and they can see the broadcast there as well. All right, so I'm going to sign off. Thank you all very much. Oh, thanks. Thanks, Juan. I'm glad you enjoyed it. Thank you. Thanks, Tom. Aaron, I'm trying to see your comment, but I can't seem to get to it. Okay, I'm still trying to, got a question here. Oh, Aaron says, thank you for your time. Thank you, Aaron. My pleasure to be here. There's one below here that oh, here we go. Thank you. Oh, here's a question. Mark, do these institutions have to pay back the bond values plus interest that the Fed bought? Do these institutions have to pay back the bond values plus interest that they're just selling the security like any other bond, and so that would not involve it just be the face value of that bond, because that interest would travel with the bond itself. I hope I'm answering that for you. And I'm seeing, how about international development? Well, that's a really good question. If you're still on here, Mr. Mueller, sometimes we do touch on that here. What about the global economy? Europe, has been opening, and so I think in the EU and in the UK, there is some signs of real optimism there. In the less developed world, there's some real issues. You've been seeing COVID really hitting South America and parts of Asia real hard. So I think in terms of and China's economy I think they're growing around 6%. So I think generally, if you look at the more developed economies, I think there's some room for optimism there if you're thinking about international stocks. Fed purchasing bonds. Now, what is this question? Okay, I'm not seeing the whole question from Aaron. I'm so much more used to Zoom. It's hard for me to see this. Rob, if you're there, can you read Aaron's question? In regard to, it's something in regard to Fed purchasing bonds, but I can't see the whole question. Let me see if I can. Okay, well, I'll just say a word about the Fed purchasing bonds from Formella. You could, Formella, if you're still here, you could even turn on your audio and ask the question. This bond purchasing issue is just, it's a form of, like, remember the quantitative easing that took place in the Great Recession, which began in 2007. And so this is sort of a continuation, a reintroduction of that policy. And it certainly puts a lot of liquidity into the economy. And that's, again, they're trying to keep a lot of money out in circulation so interest rates are low, and that businesses can get loans at low rates and consumers can get loans at low rates in order to help, move the economy forward. And when it talks about tapering or limiting or reducing or even stopping these purchases, it makes people a little nervous. Okay, I got a couple thank you. Yes, still here. What do you think is the Fed's decision on real European interest rates? Well, that's a really interesting question. What do you think is the Fed's decisions influence on real European interest rates? I haven't been following European interest rates real closely. So I'm just trying to think this through a little bit. The U.S. Treasuries still remain pretty attractive. We're still able, even though we're taking on all this debt, we're still able to sell it. And so in that sense, it might hurt a little bit in terms of European interest rates if in fact U.S. securities remain a little attractive. But still, I think the recovery in Europe suggests that their interest rates should be healthy for a period. Or the Chinese. Yeah, well, the Chinese are certainly watching this very carefully in terms of the amount of debt, and they're certainly watching interest rates. They certainly go up slightly, says Wolfgang. Okay, all right. Now I think I have visited all the questions. I'm learning a little bit how to handle this device. All right. Well, thanks everybody. I think I'm going to sign off now, and I hope you have a great afternoon. And tune in again if we do one of these again. Thank you very much. Bye-bye.